So like Jared said, my name is Ben Strother, and so I've got a background in education. So I'm used to sitting in front, I sat in front of high school for years, college students for years. Never once did they eat a meal like you had while also getting to listen to me. And so I appreciate you guys coming. So yeah, like Jared said, we're going to talk a little bit on, the idea was originally, and this was like in the fall, because we planned these things out a little bit, it was like, hey, there's a lot of things we talk about with our clients when it comes to just the investment side of things, like if an investment philosophy, a big idea you might have. Like maybe we never get deeper though. Like a lot of times we don't, maybe it takes years for us to get down that road with them. And so to be able to give a presentation where we're able to kind of hone in on some of the big ideas that, like Jared said, help us create how we do our business, how we run our business, and how we think about the markets would be a goal of ours tonight. And I've got a bunch of funny little slides up here. I created the presentation at all-time highs in January and February, and now look where we are. So I'm a real sucker, a glutton for punishment, we might say. And I've already had my pie, so I'm gluttonous there too. So I asked the question, what is the best leading indicator for the stock market, right? If you can find a thing that would help you understand if the market's going to move forward or backward, all right, what are those things? Because then it would be really easy. We could bounce out of the market if times are bad and get back in when times are good, right? It would be as easy as watching that fruit develop on the tree and then pick it off the tree right at the right time and take a nice big bite right when it's ripe. And so I thought I'd give you some examples of this, all right? And so the first leading indicator is what I like to call the Super Bowl indicator. I don't know if anybody has ever heard this, but there's a statistic out there that when an AFC team wins the Super Bowl, like we had the last 2 years, now I forget, how did this year go? Oh, sorry. Yeah, what a bad example. Because, right, Jalen Hurts and the tush push. But when an AFC team wins, markets tend to underperform, and actually in the year negative. When an NFC team wins, they tend to do well, and the market performs in the positive. Now, that has not been the case the last 2 years. Not going to lie, doesn't seem to be like it's going to be the case this year. You never know what the future holds. But it's right 41 of 57 times, a 72% return, okay, on getting that one right. Pretty crazy, okay? How about this one, the lipstick indicator? Maybe this one is grounded a little bit more. Estee Lauder has figured out, okay, that lipstick purchase and usage is a leading indicator for a recession. Why would that be the case? Because lipstick is like the cheapest way to look nice. Right, ladies and gents? Ladies? Right, ladies? So, like, that's the point. And so I don't know if it's true necessarily, right? But they've always said that is a sign. When they're selling lipstick, they know, uh-oh, our handbag sales are not going to look good in the next quarter or whatever. Okay, so maybe there's a little more truth to that. Those leading indicators are not my personal favorite indicator, and I've been talking and raving about this one since I've been a financial planner. This is the McRib effect. So when McDonald's rolls out the McRib, look at this. The market performs about 2.5 times better than without the McRib. So it says average daily returns for the market with the McRib. It's almost close to 0.1% increase on average, like daily return. Without the McRib for sale, it's more like a 0.04 to 0.05% return, right? Bring the McRib back. Also, crazy, it went away in February. It was actually being sold in just select stores across the St. Louis region and the Springfield, Missouri region up until just a few weeks ago. That's indicative, right? Yeah. Not present in 2022, and they did roll it back out in 2023, and so it is my favorite leading indicator. But obviously this is all a joke, right? This is a mix of causation, correlation, surely, unless someone at McDonald's knows something that we don't, right? or the mystery pork that they put in the McRibs telling us something, right, in terms of how all that works. It's probably not truly causal, right? It's just a coincidence, and we can look at it from the rearview mirror and it makes sense. But the truth is the market is actually the leading indicator, okay? Because this last downturn and upheaval in the market that we've seen is a wonderful example of just how quick and actually, oddly enough, in a way intuitive, that the market really is. Because the market truly is a collection of millions, if not close to billions, okay, of investors and institutions all trying to figure out the direction and the future of what's happening. And so I'm going to show you some fun charts just to kind of get going here, okay? This is showing some different recessions. The Eisenhower recession, stagflation era of the 1970s. I really hope we don't use that word anymore this year. 1980s double dip, the savings and loan crisis. All of these different examples, and on the next page, the 2007 recession, Great Recession, and then the COVID pandemic. Each one of those shows a little dotted line, all right, like you're looking for a treasure map. And that's actually the S&P 500's return. And you'll notice that that dips long before all of these other things like gross domestic product, payrolls, and earnings, okay? The market is a leading indicator, okay? The ultimate indicator, because it is a great conglomeration of so many different people and so many different minds all trying to anticipate the future, okay? What's happening next. And so you can understand maybe in the most recent downturn how all that could have been shaken up just a little bit, right? The ground shakes underneath you. Business owners go, whoa, what's the future going to look like, right? They're all forecasting their expectations. All of these market forecasters are broadcasting their expectation. There's about 1 million people in 1 million high rises, all right, in big cities. They're trying to figure this stuff out. And so what does all that mean? Well, it means like it's really hard to get into the market and jump back out and get in it and get back out in what you think is a really quick timeline. I used to ask the students this question all the time, like, hey, what's a no-brainer? If you were going to invest in the stock market, what would you do? And they're like, raise their hand, like, I would buy like whatever company sells like Hot Wheels right before Christmas, or I would buy into right before the Super Bowl, I'd buy into like an apparel company, and it's like, all that stuff's already baked in. It's a wonderful idea. You're thinking, right? Like you're trying to like figure things out. I appreciate the thought project here, buddy, but that's not going to probably work, right? And so we have to understand that the market is this complex, layered product, right? That isn't just always trading on things that are known. It's trading on the unknowns, right? And when you mix that into it and you start looking into the unknown, you also deal with these like things, right? Like our emotions and our sentiment and our political opinion and other stuff that kind of bleeds into that sometimes can affect our view on the market. And so that's going to lead me into my next question, okay? But before I get there, I want to say we live in a noisy financial world. Look at all the noise, right? These are just some examples of that noise, but there's always people who are trying to pull you in a market, out of the market, right? By manipulating our greed, our fears, and other aspects of what we deal with in our financial lives. And so here are some fun examples of how we see a lot of noise, right? It didn't take you long to get on CNBC to be like overwhelmed by all of the things that are popping up on the screens nowadays. You know what I mean? My ADD brain's like, whoa, what's that? What's this? What's going on here? It is a noisy world, okay? And so it's also sometimes makes you make this face. And that's where we are right now. Right? That guy sums it up for me, especially how we felt being in the industry the last few days. It's a tough time, right? And anytime you deal with this kind of stuff, you're going to also start dealing in the waters of emotion and the waters of expectation and the waters of all these other things that can sometimes unfurl before people, right? And so I want to begin by asking a question like, what is your investment philosophy?
Buy low, sell high.
Buy low, sell high. I love it. It's so simple, isn't it?
In it for the long.
In it for the long haul. Well, I'm going to ask that question kind of in a different way, all right, as well. So hold that thought. I want to first start with some facts here, Some interesting stock facts for the last 100 years. And a lot of you know this. You've been around for a long time. You've been invested for a long time. You understand market downturns and upticks and how to weather that storm. Sometimes when to turn it off, right? Just ignore it a little bit. Just wait till you get the statement for the quarter and not worry too much about things. When to turn it on, because you want to learn more about how the market really does work, and that's a healthy thing. Okay, but look at these numbers, because this is going to produce for us, hopefully, a preponderance of evidence that markets are a good thing. All right, that they're the greatest producer of wealth that we've ever experienced, probably in all of humanity. And that we need to, as best we can, understand them, to manage them, to put it all in right perspective. So in the last 100 years, markets have averaged a return of 10.5% a year. Okay? The market has averaged an annual maximum drawdown within a year of 12.8%. Okay? Like the longest time we've seen down from up. So we're actually not too far from that. We did cross a little bit more than that at this point. I think, I don't know, Jared's eating. What was the max? Were we close to 20%? 19%, yeah. Yep. Then it changed. We're not back to that yet. Anyway, the market has recorded annual positive returns 75% of the time. That's a lot of NFC teams that have won Super Bowl, if you're doing the math. And this one statistic just blew me away. I just popped up while I was looking at something, and I just had to put it on here because it's so fascinating. Just 86 stocks have accounted for half of the wealth created in the market. Also, the average equity investor, right, investing in the market, sees an investment return of 4.48%. So compare that with what the market actually gives us. Wow. Right, what's going on? So we'll talk about that idea as we get going. So here's kind of what we're going to go over. How we all have an investment philosophy, even if you haven't yelled anything out or haven't thought about it before in your entire life. What does it mean to invest in the market? Sorry. Why do we invest in the market? What is the risk? What is the return? What are our guiding principles? Okay. Some final thoughts with those principles. So there's a lot of people that we read in our office that we uphold in high regard. Obviously, like Warren Buffett, okay? We love it when he speaks on the market, okay? He's wise, a sage. Hope he lives another 100 years. Jeremy Siegel, when I first started working at Benson Financial Group, Jared gave me 2 books, Jeremy Siegel's Stocks for the Long Run and Nick Murray's book on what it means to be a financial planner. And so both of those gentlemen have been great influence in our industry, and they give us like fodder, right, whenever we sit down with clients and we're talking through things with them, help them understand some truths about the market that's not just, how it can be feelings sometimes. Jason Zweig is one of my favorites, intelligent investor in the Wall Street Journal. And Nick Magoli's a new guy, has written a book called Just Keep Buying, and I just reference it a lot here, so I thought I'd show you some pictures of these friends of ours in the investment world, because I'm going to quote them a lot. All right, here's a question for you. All right, what kind of investment philosophy is this? My friend's Dilbert, all right, by Scott Adams. This guy goes, I'm going to a seminar that will teach me how to make $1 million. That's not this seminar, by the way. I'm not saying that. Probably get fired from our company if I said that. And the lady goes, it's a scam. How could you know that? Oh, I haven't even told you the name of the seminar. You can't be sure it's a scam if you know none of the details. You just want to crush my hopes so I become like you. But it won't work because I have dreams. I won't be a bitter and broken cynic like you two. I'll have the last laugh after I pay my nominal fee and learn how to turn $100 into $1 million. And here's our Dilbert friend goes, invest $100 at 5% interest and wait 190 years. Thanks for coming. So that is a philosophy, right? There we go. It's that easy. 190 years at 5%. What is your investing philosophy? Okay, I ask this question almost every seminar, or I've asked this question to people anytime we end up really getting into a long discussion about money. I asked the last seminar, describe for me what things are like if all your financial hopes and dreams are realized right now. And it's actually on the paper if you wanted to look at it. You don't have to. You can just sit and listen if you like. Right? What is this? What if all your hopes and dreams are realized? What does it look like?
whatever I want, whenever I want.
Ooh.
I have to worry.
Ooh, nice.
All my dreams are mine.
There you go.
No worries, Mike.
No worries. Hey, there is like an ounce of can learn about a person by saying no worries, though. You know what I mean? And same way you can learn about. I ask this question a lot of times to like younger people in their 20s, right? Because seems like a long way away for them. They're mired in debt, right? They just need to try to find a path out of the paycheck to paycheck lifestyle, and there's a lot of things that still need to be checked off of their list before they reach financial stable high ground.
Versus me.
And what I'm saying here is like very interesting oftentimes to our retirees who have been there, done that, have come through that. Now they're like, well, sometimes they're just like, I like spend more time with my family. A lot of times it comes down to like loving your family, quality time together, and things like that. Not always. Some people are just like, more, give me more. Yeah, it's happy. But these questions, right, bleed into our investing philosophy. If you really ask yourself, like, what does it mean to invest? Why do I do it? Why is it important to me? How should I look at it? Because some people in our world oftentimes use the word like, hey, I hope I hit it rich. I hope I scratch off the ticket. I hope I like stumble upon a treasure chest full of gold someday. And sometimes that idea of luck or windfall, right? I had a great aunt that died. I didn't even know that she inherited $3 million, right? The great aunt Mildred. Whoa. You'll see it sometimes, right? Because that question will lend itself to talking about investing like, hey, it's a matter of like hitting it rich, getting this thing, right? Today I went to bed a poor man. Tomorrow I woke up, right, and I am wildly rich. And that doesn't happen very often, okay? Some other people, all right, look at this in the Ebenezer Scrooge way, really a fear-centric, I hope I don't lose it, I'm going to squeeze tight, right? You can take the pennies from my cold dead hands kind of ideas. And then down here, all right, Scrooge McDuck, I argue, is more on the greed side of things, if you know who that is, okay? Even though he's supposed to be very similar, probably more greedy with his pile of gold coins. And then in the movie Wall Street Money Never Sleeps, when Shia LaBeouf asked the question, hey, what's your number, the number that you would need to be able to walk away from all of the stuff that you're just holding on to because, you know, job or whatever that you hate in New York City, what's your number? And the guy looks at him, right? Who is that, Michael Douglas? He goes, what's my answer? What does he say? Does anybody know? Does he give him a number? What do you think? More! More is my answer. More is a definition of greed, right? How much do you need to be happy? More. And a lot of us get there because I'm sure a lot of you when you were younger said, what do I need to be happy? You know, if I had $1 million, probably be okay. And then you get there and you're like, more like 1.5. And research shows that is definitely the case. People who earn over $500,000 a year, when that question gets raised to them, you know what they say? You know, if I just had another $100,000 a year, I'd be satisfied, right? Like, I just need more, right? So there is a lot of greed that permeates this question here. And I ask all of this, right? Because it really does bleed into our investment philosophy and how we understand the world. Our worldviews shape, okay, so much of who we are and what we do. And so these little one-off answers that you see here that are spattered on the page, right, help us understand quite a bit of what really drives you or has driven you when it comes to your money and maybe the things that you hope to accomplish down the road. So I want to keep moving. What is our investment philosophy? How do we like fit this idea, okay, into our job as financial planners where we, you know, we're kind of projecting that a little bit upon you guys as clients. Well, it needs to be broad, right? It needs to encompass a lot of things. Okay, we're here to help people advance toward financial freedom is a word that we often say at work when we're together, when we're getting ready to go off and meet with clients. Okay? But that idea of establishing financial freedom, reaching financial goals, creating margin in our financial lives is what we can accomplish through investment. We want to bless others in the world around us through that, right? Because of, as a byproduct of that. I don't think, hopefully, none of you look at that and be like, oh man, you guys want people to do those things? There shouldn't be negatives, right? All those should be positives. It's things that can fit into almost every category of client need out there. So there's a lot of ways we can invest, right? Like, we're going to talk a lot about stocks and securities, investing in the market. When I say the market, that's what we're going to be talking mostly about, right? Obviously, you can invest in bonds, okay? This is ownership here. This is loanership there. Okay, so there's all these different options out there, right? Even bonds, a lot of times we talk about money markets, being in cash. We're actually talking about probably invested cash, like money markets, CDs, short-term bonds. You can also invest in land. A lot of people in this world choose never to invest in the market. They're just farmers, and what are you going to do? Well, I got more money, I'm going to buy more land. Leverage my farm to buy more farm, right? Development land, rentals, commercial real estate, all of those are options out there. Not passive investments, even rentals, all right, but they do exist. Some people are business people. Just, that's what they do. I'm a business person. I start a business. I make money. I spin it off. I start another business. I do these things. And then you can also invest in these other options as well. Derivatives are like, stock trading of options and forwards and futures based on the market, right? So we don't talk too much about those. We won't talk into that today. Collectibles, precious metals, cryptos, right? All these different options out there as well. But we always tell people, listen, there's a process we need to go through before we get into some of these things, right? Even especially like the crypto world. We need to make sure we're on financial stable ground. Make sure that, especially when you're dealing with someone who has yet to pay off all their short-term debt and pay off their high interest credit cards. You got to do that first. You got to have a little bit stored in the bank account, right? So that you're not ever worried about paying the bank those silly fees whenever you overdraft. You've got to make sure you've got 3 months saved at least in an emergency fund, right? And then save for retirement, and then save for the goals like your kids' education. Then after that, yeah, get some Bitcoin. I don't care, right? Like, you can speculate. You can have a little fun with the investment side of things. Most people invest like their dads. Guys invest like their dads, at least. So like my dad taught me early on what the market is and how it works, and he gave me a share of Winnebago when I was a kid, and I was like, cool, Winnebago, right? Like $8 a share. Dad, what's it now? $12. Dad, we should sell. Like, I wanted to be an active trader early on, okay? And I've had to be like whipped out of that interest, because then I bought a share of Reebok, and that ripped $23 to $30, and I was like, this is awesome, man. I'm hooked. Give me 2 shares, right? Got some American Eagle after that, Sonic drive-in, and that tanked. There was a great recession going on at that point. But anyway, all that being said, right, like I invested like my dad. My dad does have some collectibles, used classic cars. I'm not in that field yet. I probably won't be, actually. Unless they're micro machines, like we were talking about earlier. Yeah. So like all of these different investments, they're on the spectrum out there. This is showing us the different yields that we can get from different investments in the past 15 years. I thought it was just kind of interesting because it shows us that variety of stuff. You can get overwhelmed by this chart, right? But this is saying like in 2024, large caps, right? Like the Mag 7s, Tesla, Nvidia, Amazon, Apple. Those companies, 25% return. Small caps, high yield, equity, right? Not a good year for bonds, right? Because we still had a rising interest rate environment. Real estate investment trusts, investing strictly in real estate in a passive way. So you can kind of see the spectrum of investments out there. All right, but for the most part, when we talk about stocks and the market and equity and securities, what we're talking really is about the stock market universe, right? Large cap, small cap, mid cap, international stocks, and things like that. Okay, so all that being said, what does it mean to invest in the market? This is like hey, give me my 5 seconds of being an academic again, okay? To purchase a security, what's a security? This is the Howey test, all right? It's real exciting stuff. It's an investment of money in a common enterprise with expectation of profit solely from the effort of others. So sometimes you have to stop and say, what are we talking about, right? And that's what this is like, in order to be certified to be a financial planner, you have to go through answering questions. And it came to this definition. I just like it because it actually kind of tells us quite a bit about what it means to invest in the market. And a lot of times people don't even know that. So when I teach an online class, in finance on this kind of stuff, I have to stop and tell students, this is what we're talking about, right? We are investing our money, We are taking money we could spend right now. If we always want to spend every dollar we have, we will never grow our wealth, but we have the right to. But you're not doing that. You're socking it away. Why? Because my parents said I had to retire, right? That's normally the answer I get, especially dealing with some 20-somethings out there. But you have to do that. Defer the right to spend capital today in order to see it grow for tomorrow. And so a common enterprise, of course, you know those names, right? I just said the big companies, the small companies, the in-between companies. You're invested in companies you probably don't know about, all right? Because you're probably invested in baskets of stocks out there. Yeah, and it's this whole universe out there of all these different companies. Expectation of profit. Why else would you invest? Right? It would be a bad investment, all right, if your sole goal was to make enough money to buy a new car, to drive it off the lot, to sell it, to make enough money to buy a new car, to sell it, sell it off the lot, right? Because that would be depreciating asset. Pretty bad deal, right? We expect profit and to see it grow in value over time. Not always. As a matter of fact, if it was as easy as seeing our accounts trickle up in value, when the McRib is out 0.1% on a daily basis, it would be a really easy world to invest in, right? But we don't live in that world. Our world is, we live in a fallen world, right? Mired by sin and mired by downturns and upturns and things that can flow it off in all different places, right? And so we should, though, still expect in the long run to see profit. And solely from the efforts of others is something you do when you invest in a retirement account, when you invest in anything, right? Like that is a product that people are working and earning wages and going through all the efforts that we do at our jobs, right? So that they can create profits for companies, that companies can create value for their shareholders. And Satya Nadella, all right, as Microsoft CEO, says that gets us to the purpose of what a company really is. I think you need to actually understand this in order to invest. What is the purpose of a company? Profitable solutions to problems of people and planet. Right? That's the goal. That's what they're here for. Okay? And a lot of times, especially nowadays, we're actually in a place where we see companies as like, sometimes they get worshipped, and sometimes they get demonized. And this is saying, hey, companies are here, they exist to find value, okay, and to add value to our world. And that's a beautiful thing. We should want to invest in companies like that, right? That's not all companies out there, because some companies can profit from things that probably still aren't right, and there's some mixed up ideas in there. But for the most part, right, they're finding profitable solutions to things that we have, the challenges we have in our world. And that is in general a good thing, right? So it is good to invest, okay? Because that is providing more and more value to our world. Why do we trust in equities in the market? Okay, well, here is kind of like the start of hopefully like I call it a preponderance of evidence, okay? There is so much data out there about how well the stocks have done and the markets have done in the long haul, okay? This hasn't always been the case. We have not always been able to invest, right? 500 years ago, how did you even do it, right? The East India Trading Company hadn't existed yet. Corporations didn't exist yet. You couldn't just buy a share of a thing. What's that? What does that even mean back then, right? Matter of fact, if you lived in a feudal system, you didn't even own your land. Property wasn't even an idea, right? And so we've had all of these beautiful concepts that have carried us to where we are now. And many of them embraced in our nation, right? And which makes it so special, which makes the value of companies here so great. Something we oftentimes forget, okay? But we are in a great place where we own the means of production, because we do own shares in corporations. We have a choice. We can actually vote in those corporations as well, okay? They say basically the stock market is first and foremost a voting machine, and then it's a weighting machine. And what that means is, right, like the market's voting right now in like very extreme examples as we see, but like you can't control the market, right? It's the collective sentiment of all these different peoples and thoughts, okay? But it is the greatest wealth creation device in all of human history, and that is like not even like a question, okay? Markets democratize corporations as entities who seek to provide shareholder value, and grow that value over time. It's actually quite a beautiful thing. They have real value based upon fundamental analysis, how well they do, how well those companies create and grow their earnings over time. And the preponderance of data for the long run shows stocks vastly outperform all other options. Because another thought is, why don't we just go out there and buy bonds and buy into loanership, right? Where you're able to go out and give a loan, right, like a bank would, to a company. Well, over the long haul, this is stocks, equities here, okay? After accounting for inflation, this is 1800 to 2025, a 6.6 return, inflation at around 3, sometimes a tick higher. You'll see that's that number, right? A $1 investment in 1802, that would be like probably not your great-grandparents, maybe not even your great-great. Great to great-great. The great-great-great, somewhere around there, right? $1, $704,000 today. Inflation adjusted. Bonds, $1,700. Short-term bonds, $281. Here's your gold argument, $4.52. It had a good run up recently, right? But still, right? And then if you would have just kind of held that dollar, it would be worth a nickel. Ouch, right? Because of the eroding effect of inflation. Why do we invest? Because we need to create margin, right? It's the same idea. Why didn't you spend every single dollar you've ever had? Well, that really puts the impetus on you tomorrow to go make that dollar. And what if you're sick and you're an hourly worker, right? What if you ever want to retire? Or what if you ever just want a little space, a wiggle room, feeling of freedom, right? You got to have a little bit extra, a cushion there. And so we do it to save for our future selves. I love, there's a TD Ameritrade study out there. I've probably even mentioned this in another seminar because it's such an awesome idea. They asked young people, hey, can we like show you an image of your future self when you're retired, you're all wrinkly and old? And now it's like common because AI can do that, like this little kid picture thing. But back then, that was like 10 years ago. And what they found is if they just show you a picture of what you might look like in the future, you save more for retirement, you plan more for retirement. Isn't that interesting? So we want to create margin, right? Looked a long time on the internet for that picture to... Didn't Photoshop it or anything. To preserve our money against inflation. I took a few hours to figure out if this should be grape preserves or strawberry preserves.
Strawberry.
Schmuckers, I went with Dillman. I don't know. I think that's higher quality probably. But we invest because investing allows us actually to preserve the value of what we have. And inflation is this like slow diluting evil factor. It's a necessary evil in our present world. It will probably always exist unless we're in the midst of a very terrible downturn like the Great Recession. So we should anticipate the value of things, and the cost of things, to go up at least 2% a year. Just expect it, okay? And that's a normal economy. Milton Friedman, a great economist, though, says, listen, the worst tax, worse than tariffs, there you go, I said it, Jared. Went a long time without saying it. Tariffs, income tax, property tax if you live in Illinois, Social Security tax, all the taxes, right? All of them. Medicare. He said the worst tax is inflation. Whenever it goes it's out of hand, it's rampant, it's crazy, right? What we had in the early 80s, okay, until Volcker came in. What we had in the in 2022 is the scariest thing, actually. Why? Well, because of what it does to the cost of Subway sandwiches. And I think that's a great example because I can't hardly eat there anymore. It's so expensive. The value proposition's not there anymore. The $5 footlong's not there. Even like the cheap, meatball sub is like $8 for a 6-inch sub. I'm not gonna pay $1 per using $4,000 in purchasing power parity every year. Okay? You need to invest those funds. And investing, if done right, over the long haul, should outpace inflation. All right? At least by a factor of 2. As you age, we need to replace our human capital asset, our ability as working people to provide value to our world. Human capital is this really, really sensitive concept that we have a dollar value over our head. Right? How much are you worth? How much are you worth? I know it's not sensitive, right? It's kind of an insensitive thought that you can riddle us all down to the value we offer to the marketplace based on our education and our health and our social status and some other factors. But our human capital goes down and diminishes over time because we're not going to be producing as much for as long. And so at some point you have to replace that with financial capital. This is retirement, okay? And so that's why we need to invest. We need to invest so that we can counteract inflation, so we can save for retirement, so we can have margin in our lives in the interim. I know all this is common sense, but I hope it's interesting at least, right? Not saying I'm going to tell you anything. You're not going to walk out today and be like, wow, I didn't know those things. But hopefully it kind of reaffirms a little bit of how you treat and think about your investments, your ideas of saving and growing your investments over time. So what is there to gain or lose? It was the worst of times, it was the best of times, right? It just depends on what town you lived in. And so let's talk a little about the risk and return on the investment, okay, that maybe we would get. And so risk, potential for loss. We have a strict definition. Investment can go down maybe to zero, right? You could lose everything. Okay, you could lose it all. It doesn't take much for that to happen, right? Well, it should take a lot for that to happen. I don't like that definition of risk. A lot of times we use that, people throw that word around a lot in our industry. They say, oh man, risk, like I'm not a risky person. I don't take risks. I don't jump out of airplanes that are perfectly fine. I don't want risk in my investment portfolio. And so I don't like that definition. Okay, a looser definition, probably more fitting for that kind of thought, is like volatility or the swinging or fluctuations of value, right? What's the risk? The risk that we could see a downturn, we could see a bad economy, markets could go down 20, 30, 40% over time, okay? That's usually kind of more of an academic thought as well. I choose to look at it through another definition. Actually, our definition, probably more like my definition. Another definition says opportunity cost, right? If there is risk whenever you choose an option, that you didn't choose the best one, okay? I have that challenge when I buy potato chips at the store. Too many options out there, right? And paralysis by analysis. But what if I don't like this one and I would have liked that one? That's what opportunity cost is. My definition of risk, though, is this: not having funds when you need them, right? In an investment world, it's strictly needing money and saying, oh no, it's not there anymore, right? Because of whatever reason. Maybe it went down in value. And if you really look at that definition in the broad scope of how you do retirement planning and financial planning, you realize that risk is oftentimes more, an elephant in our mind than it is a reality. Okay, so our friends that we saw pictures of earlier, Warren Buffett says risk comes from not knowing what you're doing. He's so warm and fuzzy and peachy, right? Jeremy Siegel, stocks for the long run. Fear has a greater grasp on human action than does the impressive weight of historical evidence. And he says that probably an illustration of that contrasting rate of return for investments. Average investor gets about 4.5% return on the market. Why? Well, because they'll freak out at a downturn in the market. They'll pull out at the worst time. And when the market's roaring, like it did in December of last year, they'll say, oh man, what's this quantum computing AI ideas? I need to go invest in that, right? Like everyone was high. When buddies of mine that have never asked a question about a stock in their life, and I thought didn't even know the definition of it, are texting me about quantum computing stocks, right? I should have thought, maybe that's a sign we're getting a little frothy in the market. So anyway, good definition though. All right, here's another one for you. Okay. Actually, I'm going to talk about return first and give a couple more of those definitions. Return, growth, Growth in value. I call it the two-headed horse of capital appreciation, return of capital. All right, and investments produce income through dividends and interest. All right, but then they also grow in value. A good investment can do a little bit of both. Okay? The power of compounding. Albert Einstein called that like the most powerful force of the universe is compounding. Okay? And so if you ever had like a class where you'd have to learn about the time value of money, it's parabolic, which means it's not exciting at first, all right? Because you need these ingredients to make wealth. You need time, money, and you need to allocate it and invest it. You add all that together, and it's like this. And you're like, that's not exciting, all right? Someone takes $100 and they make $9 in their first year, and they're like, $109. Whoop, right? Like, and then all of a sudden it does that, and all of a sudden it does this, and all of a sudden it does that. And some people get the joy of experiencing that piece, right? The parabolic growth of their investment accounts as compounding can build upon itself. Okay, and it's such a mischievous little animal. You don't think much about it. You know, it's just like, oh, it's gonna $109, and next year I have $118.25. Wow, right? But then the truth is, it's so powerful over time. Okay, and I'm gonna give you an example and illustration of that in a second. Before I do, I'll show you this chart, right? I said maximum drawdown per year in the S&P 500, average around 13%. That's what we see in these red dots for every year from 1980 to 2025. We've shown you this before. It's from J.P. Morgan's Guide to the Markets, but it shows you what the markets actually did in those years, all right, in these bar graphs. So yeah, there's some down years in there, but you can see how well markets have done over the course of the last 45 years now. Really well. Even with drawdowns in the market that, if you look at these little dots, some of them are pretty intense. Jason Zweig says, the market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. And so typically you'll see that in the course of a year. We have all had the good fortune of seeing all of that in the course of 5 days. And our friend Nick Murray, he's a financial planning guru. He said the truth of equities is that if you can't ride out a 15% decline as often as once a year, and a declining average twice that amount every 5 years, that'd be a 30% decline, then you just flat out cannot be an equity investor, regardless of how desperately you need to be one. Some good words there. So some final implications. I always say it's actually young investors need risk. It's really easy, in my mind, to figure out allocations for young people, especially 20s, 30s, even 40s, or sometimes early 50s. Invest in the market, 100% in the market. You don't need anything else. Diversification really helps. And then I will get in trouble, but I'm going to say it anyway. Is this time different? Different. We hear it all the time. Is this time different, right? In the midst of a downturn, you'll always hear it. And the answer actually can be yes. And by yes, I mean the thing is different. Okay? The event is different. All right? Whether it's really bad credit default swaps in 2007, all right? Or the government pumping the economy full of fake money, real money. Can't be fake. Well, it's all fake. It's fiat. You know what I'm saying. Pumping it full of the economy in 2022, right? Or the thing that we're seeing now. The thing is different, but the markets, right? They're not going to be any different, right? The outcome in the end will be that probably in 10 years, no one will be talking too much about tariffs, right? And the economy at some point will flush it, or policy will change, or truth social text message will come out, or something will happen, right? Even if tariffs remain, markets will find a way. It's like a river, a current, right? Where companies will find the quickest, fastest, most effective way to bring product to market so that they can provide profitable solutions to problems of people and planet. A lot of P's. Yeah. And so you don't, should you worry? No. You really shouldn't, right? Like when it comes to investments in the investment world, as a matter of fact, if you're young, you've been given a gift because you get to buy in at this time, right? You get to put monthly contributions on the table, right, when markets are down. And 2022 is a great year to buy into those things. Amazon was trading under $80 a share. Yes, right? You go to Penny's and you find 80% off sweaters, you're jazzed. But stocks, you're not into it anymore. I don't get it, right? Especially when you're young. So what are our guiding principles of investing? And I'm just going to be rolling through these one after another, okay? We believe in efficient markets. Eugene Fama, 1960s and 70s, an academic. He said, listen, is it really true that you can go out and handpick individual stocks and outperform the market? Maybe I should test that. He loved testing things, okay? Actually to a fault. He just kept testing his efficient market hypothesis over and over again in all these different scenarios. And he came out with different examples of that. You can be a strong, efficient market guy. You can be a weak form. You can be a semi-strong form, right? You can be a semi-sweet. You can be a dark chocolate. All these different ideas. But what he said is, listen, stock prices are extremely accurate, reflect all publicly known information. And our world of investing has never been the same since. And we've only moved more and more and more toward his idea of what that means. And what that means is we should try to be broad, collective, diversified investors in the market at large. Instead of handpicking one of the 86 stocks that have went and created half the value in the market, you buy into the market through an index fund or an ETF or a collection of those that broadly captures the depth and breadth of the market. And if you do that, over time, we will see value added, okay? It's almost like a Darwinian type of principle. The bad companies fall out of the S&P 500. Great, they're out of there. Sorry, Walgreens, we were there just a while ago, all right? And we'll bring in some new players, right? And those companies are going to come in and they're going to be the new guys on the team, right? And they're going to hit 3 home runs as a catcher, right? In the first few games of the season, and they're going to ride up and everyone's going to love them. And that's the great thing about the market, right? Is we can invest, you don't have to do it in individual stocks. Okay, you can invest in the market as a whole and see it go up. And that all stems from this guy sitting around with his hand on his head thinking about these thoughts. Okay, our Dilbert says, I'm starting a mutual fund for investors who aren't bright enough to know their alternatives. It must be a huge market, otherwise most people would invest in index funds. And he goes, what's an index fund? And this guy goes, ouch, you're making me wag too hard, right? The dog's wagging his tail over that idea. And the truth is, that's what most of us need. We don't need outsized gains in the market. We don't have to invest in Microsoft in 1986 or Apple in 1999 or NVIDIA in 2007 in order to be wealthy. We can invest in this whole collective of the market at large, right? And earn a 10% yield, and that's going to get us toward our goal probably more efficiently and effectively than if we do our best to try to handpick the winners, all right? And so that's a concept, and we believe that. We really do in our firm, okay? And if we do buy, an individual securities, we're probably buying to kind of direct index to mimic the index anyway. So we believe in dollar cost averaging when we're young. I say this is where we all begin, right? Because most of us start on hopefully a ready and constant steady of investing into our 401k plans when we're young, and that is how we grow in wealth. Okay? Regular incremental investment of money in the market. Dollar cost averaging is beautiful. And so what does that mean, right? It means you have chosen a lifestyle with margin. You're actually saving on a monthly basis. You regularly commit to that margin growing. When markets are good, your accounts grow, and when they're down, you take the opportunity to buy because you have to, because you did it, right? Your workplace plan, ka-ching, ka-ching, ka-ching. You're sending money over, okay? The way most people become rich is through dollar cost averaging. It's a commitment device as well, because you're going to do it no matter what. And that's why it's so great to do it in your payroll if you can. But if you're committed enough to even receive paychecks and see it sitting in your bank account and then send it over to a Roth IRA or to a non-retirement account, even better. Crock-pot mentalities are needed, right? Because this takes time. It's the slow grow way of creating wealth. But you know what? Wealth that comes in slow goes out slow. Wealth that comes in quick Butterflies just leaving the room usually, right? So you have to be aware of that and understand that. And the earlier the better. If you could start when you're 0 years old, right? All the more power to you. I show this because there's always a lot of talk that different generations have it out for them, like, oh man, the boomers just had it, like you guys are just set, you know, you had it so easy, and Gen X didn't, and millennials didn't, and this chart shows generational wealth, right, as chart by the progress, and look, millennials are right in there with boomers and Gen Xers. Over time, you grow in wealth, right? Look at that, that's parabolic, just like our investments. This is our net worth, by the way, over the age that we have, so I thought that was kind of interesting. Buying the dip versus dollar cost averaging. There's a thought out there that maybe you should just wait and hold your money in cash until you see something happen in the market, right? And all of a sudden you find yourself in the midst of a serious downturn, and then you go in with all your cash and you put it all in, and does that work? And so let's say you saved $100 each month and only buy when the market is in a dip, okay? But I'm going to make this even better. Not only will you buy the dip, but you're going to make your omniscient, like, so you know when to buy. You will know exactly when the market is at the absolute bottom between two all-time highs, and this will ensure you actually buy the dip at its lowest price point all the way through all those graphs with the zigs and zags. You're buying on the downs, basically. What do you think? You're going to win? Oddly enough, you don't. Dollar cost averaging, regular, incremental, putting money into the market, beats waiting, storing up cash, and dropping it in the market at just the right time. Isn't that crazy? Like, we had a tough time with that. There's a stat from JP Morgan's Guide to the Markets. It's not this. This is from Nick Maguli, Just Keep Buying. We had a tough time even believing that that's possible. Like, you tell me at just the right time, if I just waited, stored up my cash, dropped it in the market on Monday morning of this week, that wouldn't have been better than like regular and incremental investing all through 2024 when markets were at all-time highs. The truth is, dollar cost averaging wins 70% of the time. Maybe it wouldn't have won in that scenario, but most of the time it does. Why? Because the markets are typically, all right, on a 2-step forward, 1 step back advance. And so all the time you're holding cash are those times when you're missing out on those 2 steps forwards. Even if you're just waiting for that 1 step back to dive right in, you've missed the 2 steps forwards. And then when you do get in on that 1 step back, then you've missed the next 2 steps forwards because you're hoarding cash waiting for the next 1 step back. It's fascinating. It's crazy. So we love dollar cost averaging. Okay? We love it. All right, let's keep moving. There's a lot of behavioral finance implications in this. Justin has a BFA. Jared, you have a BFA too, right? Like a lot of our planners have behavioral finance advisor designations. My PhD dissertation was in behavioral finance. We all let our human tendencies bleed into our perceptions of the reality of our investments, and we let that play out in a grand stage. And sometimes we get to play along with you guys. The results, okay, is individual investors on their own, 4.48% return on their investment. So what are some ways that this happens? Well, sometimes we get stuck in a sunken cost fallacy. Oh, I got to hold on to that loser stock. It's going to come back. That's like the most common theme, right? When I was young, I hated selling for a loss. I had some individual stocks because I enjoyed it, right? And my portfolio stunk. It was like I kept all the losers. It's amazing how that works. It's like hugging a porcupine. You're reluctant to abandon your strategy because you've invested heavily in it. Even when it's clear, you should probably have abandoned it, given up, right? We don't like to say the word give up, but sometimes you do have to realize there's a sunken cost there. How about this? Loss aversion. We prescribe 2.5 times more weight to losses than gains. If you find $10 on the street, you'll feel this happy. If you lose $10, you'll feel this sad. Okay? And that plays out over and over and over again in the markets. Makes the last week really painful. All right? And so, gosh, it's like just our natural tendency. We have to kind of, if you know that, you can kind of work against it. You know, like, hey, it'll be okay. How about confirmation bias? Looking for truths, okay? looking to confirm your belief on things instead of actually looking for the truth, probably, right? We tend to seek information aligns with our preconceptions, okay? Or confirms our thoughts, what we believe in. So there's a lot of big ideas out there in behavioral finance. This one reads, I bought my first stock and it went up 5% in 1 week. That means I'm stock picking genius. I plan to max out all my credit cards and become a day trader with them. And then the guy goes, look, the market was up 6% though. And the guy goes, that's just luck. It can't do that forever, right? That's confirmation bias, right? You're trying to find things that can kind of confirm your preconceives. So I'm going to skip the next one for the sake of time and get into this idea, valuing the market. Okay? So market does trade on valuation, and it trades on fundamentals. Okay? And so you can look at the market and say, hey, listen, sometimes the market does get a little bit over itself. It gets beyond itself based on its value. And what do I mean by value, right? Like value, like I buy a stock and it costs $30 and that's the value of the stock. And I'm actually saying no. The $30 and the price of stocks is actually fairly inconsequential. Okay, so if I ask the question, what's more expensive? Shares in Rigetti, a quantum computing company that has 0 earnings, but trades at $8 a share. Or one share of Warren Buffett's Berkshire Hathaway trades at $750,000 a share. Which one's more expensive? Well, you don't have enough information, right? But it has nothing to do with the cost and the price of shares. Okay? That's just a number. Why is it just a number? Because you don't know how many shares are out there. Right? Companies are nothing more than a giant piece of cheesecake pie, and you just sliced up all the pie pieces and you're giving everyone a piece of that, right? And so they get that, they get the good and the bad with it, right? And hopefully the earnings in that company are going to show us the value, right? Based earnings per piece of pie, if that makes sense. So Warren Buffett's company is so valuable because it's never split. So there aren't that many shares out there, right? These other companies have billions more shares. And so their earnings, they don't have much necessarily in earnings, right? Earnings per share. Okay? And so that's the value metric that we look at. And so you can look at the market like this is price to earnings ratio, how much value we have for all the earnings that we have out looking at the future earnings, right? So the market as of March 31st was trading at 20 times earnings. So like let's just pretend like, the company, let's pretend like all the companies at large, right, were at $1 per share, and so they'd be trading at $20 per share, $1 in earnings per share, right? So then you'd get that idea of 20x, right? So where is that in the grand scheme of things? Well, this is showing us all the different returns on investments based on, all right, how expensive the market gets over time based on earnings, the actual material of the fundamental analysis in the company. So you can see we're probably toward the higher end of that, okay? And this red line is showing the average mean expectation of the what you expect the market to perform that year. All right, so if we ever found ourselves at a place where the market's only trading at 10 times earnings, right, that's a no-brainer. Because you're going to see the expectation for return closer to 20% those years. Okay, so that's where we are here. I will admit, when we started the year, we were more like at 24 times earnings. Okay, so it does matter. You can actually look at the value of the market, and it's important to understand how that works. And there are times when the market can outstep earnings because of what the quote, right, from Jason's week. Irrational exuberance, right, and then pessimism, and exuberance and pessimism, and it's always drifting between the two in the most painful way possible, it seems. All right, let's keep moving. Time horizon investing is huge because it helps us understand how we should kind of allocate our investments. Okay, and this is probably we've probably got another 5 minutes left tonight, and so I've got 3 different players. All right, Johnny Cash, Barry Bonds. Anybody know this other guy? That's Nigel Stock. It's the only person I could find out there to represent our stock market idea, right? So cash, bonds, stock. And so the question is, how should you invest? How should you invest your money? So Nigel was my dear Watson. He was Watson in the original Sherlock Holmes. All right, so if you ever watched the BBC as a kid, I don't even know if that was an option back then, but there he was. That's Nigel. I'm bringing him back, man. He's huge. He's gonna be big. So like, how do you know how to allocate your investments? Well, time horizon gives you a good example of when to do that, right? So when you're investing for the short term, cash is king. Ring of fire. Why not bonds? Well, there's a chance bonds might even underperform over the course of a 24-month period. So it's best to keep your money in cash or money market if you're looking to save it for the next 2 years for a short-term need. We don't recommend people put all their money in the market. Isn't that crazy to sound? That's true though, right? We recommend people look out and say, hey, when do I need this thing? And then invest based on that expectation, right? And so this is explaining that to us. Actually, this chart here is telling us the times when even bonds could underperform to a point where it would actually take longer to reach a $24,000 goal, saving $1,000 per month, okay? When it would make sense to have more in cash than bonds. It does happen, okay? About 70% of the time, bonds will win, 70% of the time stocks will win, right? But are we willing to take that risk and spend 30 months when we should have spent 24 months or a little less to try to reach our goal, saving $1,000 a month? How about this scenario, right? 2 to 5 years, Barry, bonds, he's got a big head because of steroids, but he can wear the big crown for this, okay? James Bond, and we actually have a worker at our office, Mark Bond, also were in the running for this. But I went with the baseball player, it's spring. And so you'll see here, bonds actually are king when you have a 2 to 5 year time horizon, right? You actually can potentially find yourself in the midst of a downturn in the market. So you see this chart here. Anytime that we were looking to try to save $60,000, $1,000 a month, there were times when the market did underperform, and that cost us dearly. All right, you actually have to take, in this downturn, like say here in 2007, all right, you put $1,000 a month to reach a $60,000 goal in at the wrong time during the Great Recession. All of a sudden, it takes you 80 months to reach a goal. It should have only taken you less than 60 months to reach. So that's what this chart's showing you. So there are times when it does make sense to have a position in bonds. I mean, there were a lot of people over the course of the last several years that said, why do I, like retirees who are needing income, but the equities market, the stock market has done so well, bond market has done so bad, they ask the question, why do I even own bonds? What's the point? Well, the point is what we've seen this last month, right? And what we've seen this last month is a great example of why we need a bond position for someone who's making regular incremental pulls from their accounts, right? Especially in retirement, maybe to live on, right? You don't want to have to pull from equity markets when markets are down. And they will at times be down. It just is the truth of it, okay? And so that bond position, what we do, right, is, you know, we try to bucket that to help clients understand that, have a plan behind the scenes. Nigel, my dear Watson, I can even try with the British accent, right? Stocks reign supreme, though, if we have a longer time horizon investment opportunity, right? Stocks for the long run. If we go 8 to 10 years, okay, there is virtually no incidence of a downturn in the market, okay, if we go out more than 10 years. And so how can we look at that when it comes to retirement funding? And I think these are cool, right? So bonds have things called, like when they call it taking a coupon, taking interest from your bond and living on it. Back in the good old days, in the 1800s, people would actually receive a physical bond, maybe from corporation, from the government. They would buy the bond, and then they would actually clip the coupon over time, take it to the bank, right, these little coupons, and say, I need my Social Security money, because Social Security doesn't exist anymore, or doesn't exist yet, right? And so that's kind of a neat idea, okay? And so what we try to say is, listen, when it comes to retirement funds, we do have a timeline. We do have to have a plan behind the scenes, right, to understand when we need to pull, all right, so we can invest for the long run, some money that we need in the market, right, typically for a 10-plus year need in our retirement, because our retirement's going to last longer than 10 years. And then for the rest of it, we can still make work in the bonds. We can clip the coupons if we need to, okay? Hopefully not clip the Kroger coupons or the county market coupons, unless you like to. So this is showing this example in real terms here, right? The range of stock, bond, and blended total returns for the market over the course of different intervals. So in a 1 year, it is a mixed bag. The market could be up 52%, it could be down 37%. That's up best, worst, right? It was the best of times, it was the worst of times. 5-year rolling, though, we see those flatten out a little bit. 10-year rolling and 20-year rolling, we see those expectation for returns narrower and narrower and narrower, right? But look at that 20-year rolling. We see here, at worst, a 6% return in equity markets, at best an 18% 20-year rolling return, right? People are worried. They're pulling money out of the market as we speak, okay? And they're probably going to get back in at some point when markets are higher, or they're never going to be able to get back in because they don't feel comfortable doing it. And the opportunity that they have, especially with money that they're not needing in the next 20 years, we see as virtually zero. Honestly, we do. That's how we look at it, okay? And you know, the this time is different mentality can sometimes get you in trouble, right? We're not saying that this time isn't different, right? Every scenario is different, all right? But the truth is, markets will find a way to make profits and to grow their earnings, and companies will find a way to do that under most any environment, some better, some worse, right? And that's why these numbers are different, okay? But in the end, it's good. It is good to be invested in the market, okay? And it will help people achieve their financial goals and dreams, all right? And so the last thing I have on here really doesn't have much to do with investments. It has more to do with when we build financial plans. The challenge that we have is a lot of times it's not a matter of what you have that you've put in, it's how it's going out. And the original Thomas the Train Engine picture right here, that's Cornelius Vanderbilt. He was the second wealthiest man in the early 1900s, right? Like built this grand empire of, you know, in the train industry, railroad industry, and two generations later, gone, all spent. Why? Because out it went, all right? And so we have to worry about that. And so I always say there's a more is less when it comes to this kind of thing, that sometimes the more people have made and the less that they're able to save, they're actually in the hardest financial planning, especially retirement planning picture you can find, because they're used to spending more, they've saved less, they've shown that they've been able to create less margin in their life because of consumption. And so we have to balance that out and say, listen, right, that is half of financial planning, is human behavior and how we spend. Okay? The other half is, of course, all the other stuff we've been talking to up this point. But I would be so reluctant to not include that, because when I'm building plans, that's like the biggest surprise I have is the toggle of retirement spending, right? It's like, that's so sensitive. Someone spends $100 more, $100 less dollars over the course of a retirement, it can change a plan. And it's just wild to think about that, right? When it comes to even our financial life, when we're working and we're young and we're making money. Right? If you can just create just a little bit of margin, all of a sudden you find yourself in a place where you've created a lot of margin in your accounts. It's so great. Okay? And the poor Vanderbilt family, right? And didn't have a school named after him, but still. No one should probably feel bad for him. So final thoughts, right? This is Jack Bogle, okay? I consider myself a Boglehead, a follower of him. And so he kind of followed in Eugene Fama's efficient market idea. He said, but he was a businessman. So he's like, hey, listen, I'm going to create the first index fund. And so he created that through his Vanguard company. And it was a huge success. And so much so to the point that our industry has been moving and shifting away from mutual fund and active management to passive management. Just collect the market and invest in the market as a whole. All right? Thanks to my Boglehead friend, okay? This great guy, he died not too long ago. We believe the following investment philosophy can best help our clients reach their goals. Ready for this? We work to invest in a way that captures the depth and breadth of the equities market, achieved through diversified exposure to a low-cost passive investment portfolio. Okay? And we think that goal of not trying to outperform the market, but not trying to underperform the market, okay? Not going out and taking wild leaps is all we need, all of us need, to be able to achieve what we want to in our lives when it comes to our money, okay? And the low-cost key here is really what Jack was able to achieve, right, in his Vanguard company, because index funds are incredibly cheap, effective ways to invest in the market, and that's why we offer those to our clients. Our final thoughts, okay? Do you believe in stocks for the long run? Look at the history. Look at what it's done, right? And annualized real returns over the course of time has shown that the markets have done really well. And we are extremely blessed, all right, to be the benefactors in a passive way to that. And so my last question is, why are vampires so rich in movies? Why did Bram Stoker, why is that? Go ahead, Connie.
They live so long.
Or yeah, because they live so long, right? And so if we remember our equation, time plus money plus desire to invest it or save it, we will become wealthy. And so that's why they're living in castles, right? They might be a little dusty, a little dark and dank, but they're living in castles, right? They're pretty rich. And so I was just curious if you knew why vampires are rich. Hey, I want to stop and kind of come full circle to the idea of investment philosophies and worldviews and end with this thought, okay? What if all your hopes were financial hopes or dreams were realized? What would it look like? And our goal is, this comes from Nick Murray, our sage for investments and financial planning. But he had this quote, and I love it so much. This is kind of more, it's more than just investments, right? Because when you create wealth, it's a path by which you can do things, achieve things, and help people. And so he says, we're looking for, as in we financial planners are looking for people as in clients. And I think we're blessed to have clients that very much align with this thought right here. Read this. It says, financial hopes seem to be expressions of love. What money will enable them to do for themselves as complete human beings, for each other, for their children and grandchildren, for their church or school, and things of that nature. So, thank you guys for coming. Have a good one.